folks. It's Dave Burrows, and we're ready for another Tuesday afternoon Barometer Readings webcast. I want to thank everybody for tuning in. We've talked to lots of clients over the last few days. Lots of questions around, what maybe we expect from what we might expect from the election and how that might impact markets. I'm always a big believer that the market is the single greatest analyst. All of the information goes in and price behavior comes out. But I've asked James Callahan to jump on with me today. We're going to talk a little bit about the election, given the fact that it's a week away, and what we can glean from what's coming out of the market. Just to start from a super high level, as we always do, we think we've been in a bull market since 2013 in U.S. stocks, and of course other markets have joined in along the way. U.S. stock market went through a very difficult secular bear market that ended in 2013. Two major declines, the financial crisis and the tech wreck. It lasted 150 months. And since then, we've had 42 months of the market working its way higher. We've had bull market corrections or cyclical bear markets along the way. Most recent one, December 21 through October of 22. And we talk about the fact that when you get out of those periods, what comes next tends to last for a while. So we've been 2 years, just through 2 years of a bull market. Markets had relatively low volatility. There's been some pretty clear market leadership, which is typical in a long-term structural bull market. So 42 months, that compares to 217 months in the 1980s and 90s, arguably. This can go on a long time. People are always worried about the market making a high and it all being over. We'll talk about whether we see any signs of that. But when we look at the short-term picture, this is the low in October of 22. We've had a series of higher highs and higher lows over the course of time. We've had a market that's been broadening both by theme and by market cap, different cohorts joining the rally. And of course, the S&P is trading just a snick off its highs. If we look at the equally weighted S&P, it also made new highs. In fact, it made new highs before the market cap weighted S&P 500. When we look at the midcaps have had a dynamite 6-7 weeks since September and actually has been leading the market. So that's performing well. And that's a group that did not perform for a long time. In fact, it went from late part of 2021 until early part of 2024, we made this first new high. And then there's the NASDAQ. Now, the NASDAQ certainly has been doing a little bit better. It has been unable yet to make a high that was reached in July. It did have a pretty significant 16% pullback, but has again been working its way higher and higher highs and higher lows. And this is an important week because we get into some of the big cap tech earnings. And so lots of people holding with bated breath to see how those companies report. And certainly we'll have James on to talk about some of those companies as that happens. When we look globally, global stocks have continued to act pretty well. Really, most geographic regions around the world are seeing positive and expanding breadth. Europe has continued to improve. Asia Pacific has been strong. Canada, next to the U.S., performing well. In fact, outperforming the U.S. right now year to date. A bunch of Latin American countries doing pretty well. Japan has seen some weakening in breadth recently, partly on the weaker yen. But when we look at the index, it's really just been consolidating here over the last, this is about 6 months. We had that one really tough month where we dropped and then closed right back in and around where we had started on that month. So still, it looks like it's relatively early days for a lot of these global markets. And it looks like it's relatively early days in this bull market for the Canadian stock market. So things certainly seem to be doing okay. If we go to the bond market, the bond market is been weak recently. We saw generational low in rates in 2020, much like the late 1950s. When we look at yields, they've been working their way higher since mid 2020, higher highs and higher lows. And you can see that we've had a very significant spike in 10-year yields over the last month. We were as low as 370. The 10-year yield has moved up to 4.28. It is interesting because it's the first time and biggest move in rates going higher after a rate cut that we've seen. So the administered rate, the 90-day T-bill taken down by the Treasury, and the market, looking at longer-term Treasury yield, says the policies are inflationary and they're taking yields on longer-term bonds up. So in fact, more yields on mortgages, the interest rate on mortgages has moved right back up toward highs. So this isn't a surprise because we've had good economic data. The economic surprise data in the US, this red line shows that more recent economic data releases have come in general better than expected. And with that, the 10-year yield is saying, well, what is the need to cut if we're getting economic data coming in better than expected? Now, it does tend to happen. You can see it happened back here in early part of 2024, yields moving higher along with the economic surprise data. But there is some concern that the Fed could keep creating a more inflationary policy. So TLT, which had bounced a little off the lows, basically right back toward the lows, down 10 points in the recent days. So for income investors, bonds have been really problematic. This has been a 4-year bear market that's unprecedented in the last 40 years. And really, things are not getting a lot better. We've preferred to focus on dividend growth stocks for our income investors. They've had a really great relative return versus bonds. Since we saw that generational low in yields, we had a first run up. We went through a tightening cycle by the Fed and other central banks. And in 2024, once again, dividend growth stocks way outperforming. I mean, to put it in context, since March of 23, the equal weight S&P is up 32%, the TSX up 33%, the bond indices in US up 4.71, that's total return, yield minus capital growth, which we've seen contraction. Canadian bond index the same. The investment grade corporate bond ETF up 8.6%, and the tactical income portfolio that we're running here at Barometer up 35.7%. So clearly dividend growth really continues to lead, and we think this is going to be the case for some time going forward. Just quickly on the commodity front, long declining bear market in commodities ended in 2020 with a very significant move higher. We've been through a tightening cycle. And the commodities do look like they're resolving higher. They're not all moving at the same time. We talked last week about gold, and gold is really rocking. It's up almost 42% now on the year. It's about the best performing asset. This is a clear nod to the fact that there may well be devaluation of our purchasing power in currencies. Central banks around the world are replacing treasury holdings with gold holdings. And interestingly enough, private investors, for the most part, have been disengaged. Now, we talked last week about the fact that it's now 41% above the 200-week moving average. And we like to watch how stretched things can get. In the previous bull market, in each of the 3 legs higher, it got to 85% above the 200-week, 83% above the 200-week, and 78% above the 200-week, which of course was rising the entire time, leading to a gain of about 345%. We currently are sitting 41% above the 200-week. So that would say that if we had a bull market that was similar and we came out of a bear market that was quite similar, then we probably have a long way to go. If you went all the way back to the bull market of the 80s and 90s, sorry, the 70s and 80s, after its bear market, 68% above the 200-week, 160% above the 200-week, 170% above the 200-week, and 130% above the 200-week. That's without the blow off top late in 1980. So we think this is early days. We talked about the fact that private investors have really only just started to accumulate gold holdings through the ETFs, and silver, of course, has joined the rally, and we think that that could have quite significant moves as well. But that's one asset. And what it tells you is that central banks and private investors, when they're looking to hedge a risk, are less interested in hedging a disinflation risk, which you would do with fixed income. And instead, they are hedging their risk in their portfolio, and they believe the greater risk is inflation. And you do that with inflationary assets like gold or commodities, or possibly even Bitcoin. So the US Treasury, as we talked about, is now less volatile than a Treasury bond for the first time in a long time. And central banks are very actively adding this to their reserves. This comes from the IMF, and it shows that central banks now are holding 12% of their assets in gold. That's up from about 6% in 2014. So a doubling, and the rate has been accelerating. So when we look at relationships, it's always important to recognize inflections. And what this shows is that through the 2000s, gold outperformed stocks quite substantially. And then from 2011 through the present, or through 2021, gold underperformed stocks. Now, just because gold is outperforming, and we want to make note of that because it's our job is to get to the parts of the market that matter, it doesn't mean that stocks aren't doing well, because you can see that stocks in general are doing well. It just happens to be that gold seems to have made an inflection on a relative basis. Copper looks like it's trying to come out of its long consolidation, but that's more economically sensitive. We probably need to see more good economic data. So ultimately, we don't have to be everywhere. Our job is to constantly ask the question, are the things that we hold in portfolios relevant against the alternatives? Are there things that are better? Our job is to be in market leadership, and that could be sectors or themes or geographic regions. It could be almost any asset. Second, we have to recognize change. And third, in the absence of leadership, be prepared to hold cash. Well, we've talked over the last several weeks that there's actually quite a lot that's working in this market, and we've got lots of choice. But ultimately, our job is to be tactical and find parts of the market that are seeing expanding breadth and avoid parts of the market that are seeing deteriorating breadth. So, top-down piece helps us to find the right neighborhood. The bottom-up part of our process is aimed at finding fundamentally sound companies that are good getting better, that are also technically sound. And then we build the portfolio out of the companies that we find that are good getting better in parts of the market that people care about and that are seeing expanding breadth. And by doing that, we address each of the factors that drive return. The final piece is that we use stops on all of our positions, because at the end of the day, every position has to be sold at some point. And generally, you want to be selling it before everybody has come to the conclusion it's a weak asset and it's down a lot of money. Make sure little mistakes don't turn into big ones. Okay, so last week, we highlighted that our long-term indicators, the percent of stocks in uptrends, has been expanding. And that our short-term indicators, which are shorter-term measures of trend, also largely positive. Now, we said we're 2 weeks away from an election. Generally, you might get a little bit of chop. And while the long-term indicators have stayed positive, the shorter-term indicators are showing some weakness. So, if we look at the main indicators, we can see that the percent of stocks with positive trend continues to be positive. The percent of stocks above the 200-day moving average has stayed close to 80%. What does it look like when you're headed toward a problem? It looks like the percent of stocks in uptrends, and we're measuring here by the percent of stocks above the 200-day, deteriorated into the market highs in December of 2021. And this is why we watch breadth, because while the index continues to be carried by the leading stocks, if the percent of stocks performing well starts to falter, it tells you there's deterioration under the surface. We're always watching. So this is one indicator. We look at a number of them that are similar, but the net of it is we are seeing continued strength overall in breadth. Now we're headed into the strongest, most important week of the year for earnings reports. The October 25th week and the November 1st week are chock-a-block full of big company reports. The TSX and Canadian market really gets into full swing for earnings reports late this week and early next week. So both being important. But the biggest buyer of stocks in the market, corporations who are buying their own shares, are now well beyond the blackout period where they can't buy their shares. So this is helpful because they can absorb loose sellers, maybe who are trying to lighten up ahead of an election. The corporations can start stepping in. And there's a lot of shares to buy. Companies have announced record buybacks for this year. So now we got the election coming. Let's talk about the election for a minute. I've had all kinds of questions to say, well, which sectors should do well if one side or another wins? What are you doing prior to the election to moderate impact in the portfolios? Are we concerned if one side or another wins? All of them logical questions. But the thing we have to remember is that the market is a machine with 1,000 moving parts. And there are some high-profile news items that undoubtedly matter, but don't carry the day in every case. There's all kinds of other impacts that work their way through a market. I like this chart that I saw from earlier this week. It looks at how the stock market did under various administrations, and it's very clear. You know, the market can do poorly under a Republican administration, or it can do really, really well. It can do poorly under a Democrat administration, or it can do really well, because it's not just all about government policy. It's about what's happening in the world and what's happening in the industry and how it all integrates together. But we have to think about the short run. What is it in the short run? I thought this was interesting. It was from Morgan Stanley, and they took the poll numbers from Predicted and the odds of victory in the betting markets. And what you can see is since September, the odds of success based on Predicted models are showing that the Harris presidency is becoming less likely and a Trump presidency becoming more likely. I like to listen to what the market has to say because, as I said before, the market is the smartest analyst there is, takes in all of the information and price behavior comes out. We can see that some of the things that Morgan Stanley considers to be more tied to Democrat policy have been performing worse in the market, while things that are more tied to the Republican win are doing a little better. So without going too deeply into the baskets that they've created things that they think would be beneficiaries of either side's policies. But let's take a look at it from our point of view. And I've asked James to jump on and take a look at our typical leadership slides and see what we can glean when we put the mosaic together. So let's start with financials. Financials have been prolific over the course of this year. They're up sharply, much more than the market. And when we look at the last number of months, steadily marching their way higher, including this month, where we're basically trading at new highs. So James, talk to me a little bit about financials and where this leans if you were to pick policy.
Yeah, absolutely, Dave. And I mean, the financials have been working really well. It's probably been our biggest weight, our biggest sector weight across the firm for the last 18 months, I think, if not longer. And I guess to look at it from a policy perspective, and we're not trying to make a prediction or a call. All of this has come up organically through our process. But a Republican victory generally means deregulation for the financial space, which is considered a tailwind, especially for some of the regional banks. They're a little bit smaller. And this is a theme that we've seen emerge really in the last couple months, and we've added a couple regional banks as this has emerged. When a bank in the U.S. crosses the threshold of about $250 billion in assets, they become subject to much more stringent regulations, and their reporting requirements become a huge burden. So if we see a deregulation push by a potential Trump administration, it should alleviate some of that burden. That's part of the reason why these stocks have lifted. I think beyond that, and we've talked about this, Dave, these names have been unloved for a long time post the collapse of First Republic, Silicon Valley Bank, a lot of the stuff that we saw early last year. Those acute funding issues are now long behind these names. Rates have moved structurally lower for a long time over the last 18 months. The health of the US economy has been in question. I don't think you can debate that now. We've seen such strong economic data that is unquestionable now. The US economy is strong. And these are good businesses, good businesses. They're getting better. We're able to get geographically targeted, which is quite nice. This is the chart of Regions Financial. They operate primarily in the southern US states, Florida, Texas, in the Midwest. These are all areas that benefit from reshoring, which will also be a theme if we end up with a Republican administration next year. So there's a lot to like. Regions yields about 4%. We've also added M&T Bank that yields just over 3%. These names, we like them a lot through our process. It looks quite good. As I say, we're not trying to make a call. These are all things that have come up organically through our process, and we like them a lot. And it's been a long time since we owned the regional banks. They're great names.
It's interesting, isn't it, James? Because in the end, I mean, each party has their policies. And I think anybody trying to predict based on, speeches and platforms who's going to win, you're going to have a tough time. But I do think that the market tends to speak to us. One of the clear policies that Trump has brought in his campaign is for deregulation. And certainly the financial services industry went through extreme regulation after the financial crisis. And many of the smaller financial services companies really were hamstrung by policy and by regulation in their ability to grow, because as they grew over certain thresholds, they had much more stringent regulatory burden. And this could certainly help these folks.
Yeah, and even under the current administration, we've seen the tone of bank regulation take a step back a little bit.
Yeah.
When we look at what was proposed for Basel III Endgame, that originally was much more stringent than what it seems like we will get. And the bank stocks have worked well on the back of that. That generally benefits the larger banks that are subject to CCAR and the like. But I think across the board, it does matter. And then, as you mentioned, if we think we go into a period of inflation, a lot of these names work well. They grow their dividend, and that's a good place to be as well.
Right. Now, what about industrials? We've seen industrials lead, and certainly, there's a group of these sectors that really have blasted off since the beginning of September, and industrials certainly are one of them. The industrials also tend to lean a little bit more to benefiting from Republican policy than Democrat policy. Certainly if there's going to be tariffs, then reshoring accelerates. If there's deregulation, it helps some of the industrial companies. I look through to other sectors like communications. Now, like Google and Meta and Netflix, or hate them, they certainly have been under scrutiny in a Democrat administration. And here they made new all-time highs today and have moved higher for the last 5 days. This also paints a picture that the market may be sensing a closer tie to a Republican win. And then mid-cap stocks, again, similar to the regional banks, have suffered under difficult regulatory environment, and they would be a beneficiary. On inflation, we've focused a lot on inflationary assets over the course of the year and tried to work hard to hedge against it. Inflation doesn't appear like it's completely going away. Do you think that there is more inflation under one or the other administrations if they were to win, or is there anybody who seems to be willing to cut spending?
No, neither will cut spending. It's hard to say specifically what will get done, because I think from both candidates, we're still seeing campaign promises, and we won't know what actually materializes until one person is in office. I think that under a Republican administration, we'll likely see bigger deficits because the focus will be on tax cuts and the like. And there's a lot of unknowns. What sort of tariffs will come, how big they'll be. We'll invest with whatever kind of market that we end up getting. But yeah, I think under a Republican administration, we see bigger deficits. It'll take a while for them to get things done. So
Yeah.
I think even if we see sweeping tariff programs, that probably doesn't come in the very beginning of 2025. It's probably a later part of the year story when they get sorted. And even if we look at the first Trump presidency, wasn't really until 2018 that he cracked down on the trade war,
Right.
and really brought in a tariff program. So that was a couple years post him being in office. So maybe we see something similar now.
Well, either way, it looks like the bond market doesn't like the prospects. Look at the sell-off we've seen in the long end of the US Treasury market. Really tough. I would tie this more to the Republican side. Bitcoin breaking out to new highs today. And I think that that's actually a pretty big deal. It's been in a bear market consolidation since 2021. After the last big run up in price, this probably kicks off a new leg in the bull market here. Probably tends to leans a little bit more Republican. And tied in with that, certainly the move in gold is tied to inflationary concerns as well. Just on energy, a lot of people were confounded by the fact that oil prices didn't move considerably higher while this conflict has been going on in the Middle East. But as you can see, the U.S. has become a lot less dependent on foreign oil. Is there anything that you would take away from the fact that we've seen crude break down in price below $70 over the last 60 days? Can that be tied one way or the other?
I think it skews more towards a Republican victory. If you think that we get loosening restrictions on energy companies' ability to drill in the U.S., likely means lower crude prices. I think that's what's being telegraphed. But it's not really been a focus for us in the last little while. We've not been too heavy into the energy space right now, and I think that's been the right call.
Yeah. Going back to trade, I thought this was interesting. This is the chart of the Mexican market, and it actually was performing quite well until the spring of this year. But certainly it's had a very, very tough go, both absolute price and relative price has been weak. I think that that's probably tied more to a skew toward Republican win. And then the other side, there are many that have said that the consumer would likely benefit from a little bit more friendly fiscal policy to the consumer under a Democrat win. And we're just not seeing anything follow through there. The consumer discretionary relative price strength versus the market has been weak, and also consumer staples. So these are tricky things. The last one that you would think might be more helped under a Democrat environment would be environmentally friendly renewable energy and electric cars, and both of them have been very, very weak on a relative basis as well. So the things start to stack up here. Healthcare, which arguably would be likely to see more spending under a Democrat presidency, has been weak also. So it seems to me, James, without us trying to guess at who's got better policies, the market is speaking here and saying it is more likely that we see a Republican win. As it turns out, I mean, we just follow the market and we follow our process. And as it turns out, our big weights really all year have been financials. We've had a pretty significant overweight in industrials, materials for domestic consumption. We've stayed pretty light on consumer staples, healthcare, and consumer discretionary. So all of this, I think, is in line with our positioning. But it'll be interesting to see what happens. The one thing I think that's a wild card is if it's a dead heat. I don't think market's going to like that. And so I suppose possibly if you had a dead heat, you could have something extended. This happened once before in the Gore-Bush election, if I recall. I think if we go back to Gore Bush, the market stayed sloppy until they settled things in December of that year. And ultimately then market reacted pretty well. So as we sit, now going back over the last 18 months, market's been pretty solid. Bonds haven't been that solid, but they've been positive. Our income fund's up, whatever, 35%. I think the equity fund's up 39.9%, and our global fund's up 39.4%. We're feeling pretty good about things. We are in a liquidity cycle. Credit spreads continue to be pretty tight, so they're not telling us there's any problem in the credit markets. Volatility is well within the sort of bull market range that we tend to be in during the better of the bull markets. And we're moving forward. Now, moving away from the election, we said last week, if a bull market got through 2 years of age, then ultimately the next number of years were pretty good. On average, the bull market lasted 5.5 years before the first 20% correction. So we're 2 years in. That could leave us 3.5 years in front of us. Looking at the graphic, there's a bunch of much longer bull markets. We're also through the seasonally weakest 6 months of the year. Once you get through the end of October, you're into the seasonally strongest 6 months of the year. And when you've had years where the 6 months that were supposed to be weak were strong, like this year, tends to be the next 6 months are pretty darn good, up an average 13%. Finally, seasonality. We're in the strongest 2 months now of the year, November, December. Election years tend to be a little bit sloppier than non-election years since 1950, but they both tend to perform pretty well. So ideally, we will see some kind of a decisive victory one way or the other. The thing we don't really want to see is wrangling over results. But that's why we don't get too far out over our skis. James, are we forgetting anything?
No, I think that's pretty much it. If I go back to some slides that were shown earlier, just maybe another comment on why the industrials have worked so well. It's economic strength and it's reshoring, yeah, but it's even something like Uber. Under a Republican administration, we get deregulation of the gig economy as well. That has been a focus of Democrats to crack down on contract workers and gig economy names, and then to move to the communications names. There's absolutely a reason why Google and Meta and these names are working well, as the message of the market seems to be telling us something about the results on November 5th. We likely see the FTC reined in substantially, and we likely see the DOJ reined in substantially as well. Maybe that changes the outcome of some of the actions they've taken recently in regards to those mega cap names, Meta and Google. Right. I think that's another message the market's sending too.
Good point. Good point. Well, so we're invested. Sector themes seem to be working. We're looking forward to getting beyond this election so we can maybe hear about it a little bit less. And if things were to get more difficult, there's change for the worse, we'll certainly be willing to get defensive. But we think the most important risk to protect against right now is inflation. I think we're well protected against that, and our themes are working quite well. So with that, we'll see if there's any questions. But James, thank you very much for jumping on today.
Thank you, Dave.
See what we got here. Well, questions. We have no questions. Lots of people on today, but no questions. James, you did a great job.
Yeah, you as well. Thanks, Dave.
Thanks, everybody, for joining. And we'll look forward to being back here next Tuesday. There'll be lots of other things to think about that day, too. But if you've got questions in the meantime, don't hesitate to reach out to us. If you're too shy to ask a question online, send us an email or give us a call. We'll be happy to have a chat. Have a great day. Have a great week. Thanks, James.